Early in 2012, the former chairman of Sprott Asset Management, Peter Hodson, announced the formation of 5i Research Inc. 5i Research provides independent, conflict-free advice on stocks and investing. They believe that investors pay too much in fees and could do a large portion of the investing themselves. Furthermore, they believe that some of the best companies, those that never need money, are ignored by the investment industry since they don't generate massive fees for brokers. In June 2013, we asked Mr. Hodson to tell our viewers more about 5i Research. What are your views on resource investing? Do you think that there will be a turnaround in investor sentiment anytime soon?
Yeah, I don't think we've seen true capitulation yet. It's not a situation where you've had, I think if you can put your portfolio manager hat on again. So say we started 2013 and it didn't look so good for resources. So what managers do is they sell their good companies first, the ones that have done better, the ones that are liquid, the ones that can actually get a bid and you can actually get a transaction done. So you do that, you get some more redemptions, the market goes down a little bit more in the resource sector, and then you look around and say, well, I've sold all my good names, now what do I do? And you know, the way it goes is the not so good names, nobody wants to buy them, and so you have to take successive price haircuts to make a transaction. So I don't think we've got to that point where the managers as a group, the resource managers say, get me out of this because I need the money and I don't care what the price is. Because really, as a manager, once you've decided you do not want to own a stock anymore, you don't really care that much about the price. If the stock's $8, you need to fund a redemption, you'll take $7, you'll take $6.50 because you don't even want it anymore. You want it off the books, it's gone from your brain, you don't want to do any more work on it, you just want to get out. I really don't think we're there yet. But I'd have to sort of get in touch with all the redemptions at all the companies to sort of find out when that might happen. So I think that's why I think we'll probably have short-term pain before we get the long-term gain.
What about gold's roller coaster ride lately? Do you think the yellow metal has lost its luster as an investment choice?
We get tons of questions about gold, but I don't think it's lost its luster. I think what happened was because gold went up for 12 years in a row and everybody made lots of money, then it was also acting very well as an insurance vehicle for when the financial crisis hit. It was one of only, I think, 2 assets that went up in 2008. So I think everyone sort of forgot that gold can go down. It goes up, goes down, as my wife says, they all go up, go down, whatever. And so it's a situation where people just got over levered or over invested in the sector. And now they look at it and say, well, we need to balance the portfolio out because this sector is not working too well and that other sector is. And so, but as far as the reasons to own gold, whether it's inflation protection, insurance, protection against a massive financial scenario which is negative, none of those have changed. There's still money being printed every day. So from an investment thesis point of view, it's absolutely still intact. It's more asset allocation and sort of proper diversification that people are taking a look at. But it'll change very quickly. I mean, people get greedy, and if gold goes up $400, the whole sector will come roaring back. Again, we need that monetary velocity to increase, and we need the inflation expectations to increase before that happens. But the reasons to own gold are absolutely still there. On the stock side, there's too much selling because of redemptions, but the fundamentals, nothing's really changed at all. I mean, if and when the Fed decides to pull back stimulus, that may have a short-term impact on gold. But if you look historically, gold's done better in good economic times than bad economic times. So if we pull back stimulus because the economy is rock and rolling, gold will probably be okay. So it's good insurance. It does well in bad times, and it can still do well in good times. To me, it doesn't sound so bad. It's just you got this backdrop of fear and negativity, and a lot of people are questioning why they own it. If you really sat back and said, well, I own it because this, and this, you would still own it. You might not like it, but you'd still own it.
Are there any stocks that you like and can discuss with our viewers?
Sure. I mean, what we've tried to do is we're, at 5i, one of our biggest signals is the first dividend. And so we've found that if you're a company in the 300 or 400 million market cap range or even higher, and you pay your first ever dividend, then it sets up really good long-term growth going forward, especially if you raise that dividend. We're not talking a company like Apple, which has got so much money they don't know what to do with it, so they're just handing some out to shareholders. We're talking about a growing company that wants to get noticed and into the next sort of realm of investors. So one is Stantec. It's an engineering company. They paid their first ever dividend last year, even though the company's been profitable for 45 years, and they've gone through all these cycles. It took them 45 years to make their first dividend payment. Since then, they've raised the dividend. The stock's up about 50%. And they're just sort of getting into the next zone. There's a few like that that we like to focus in on. A company called Badger Daylighting. I can't drive anywhere now without seeing their trucks. They started off as an oil and gas service company, and they use vacuum and water to dig trenches and holes. But they started off oil and gas, but now they've just totally started to dominate the utility sector, where instead of 5 people from the phone company digging a trench over a week, they come in with 1 truck and 1 guy, and they dig it in an hour and a half, and they're done. So that company was the target of a takeover a couple of years ago. They fought that off, or the shareholders rejected it actually. The takeover bid was in the 20s, and now it's 47. But from a growth perspective, it's just massive growth ahead of them in terms of the opportunity. One a little bit more risky, we've got a pretty high rating on it, is Amaya Gaming. In the downturn of the gaming sector in Canada, we had Cryptologic sort of just trading at its cash position. We had Chartwell Technologies trading like nobody cared. And they came in last year and bought both those companies over the past year and a half, set themselves up perfectly for future growth of online gaming. Then they went out and bought a company called Cadillac Jack, which produces the actual hardware, the real gaming stuff for casinos. And now here's a tiny little company that's just come out of nowhere. Their revenue growth is just massively accelerating. They're profitable, and the stock's gone from about 2 to 6. We actually like it better now than when we first put a report on it at about 240, because now they've got the revenues, they've got the cash flow, they've got the business, and they position themselves perfectly for future growth. I don't know what happens in terms of internet gaming, but right now it's banned, so if it gets unbanned, it's net positive. So really like that company in terms of what they're doing. And we also, there's one gold company we follow, just one. If we did anything right at 5i, it was not to go too crazy in the gold company. But that's Goldcorp. I mean, it's got a great dividend. If I could, a couple of years ago, if I told you that some of the senior gold companies would pay you a 4% dividend, you'd just laugh me out of your office because it just was unheard of. But now, because of the valuations, we've got these great dividends, there is growth and there is leverage going forward in some of these companies. So gotta like Goldcorp. And then if you're really shy about the market, we've been telling investors to buy Cineplex. Everyone thinks that Cineplex is going to go the way of the dodo because of Netflix and because of home theaters, but they forget that the movies is a social event. It's got nothing at all to do with the movie. It really doesn't. It's where all the teenagers go and party with their friends. And here's a company that is doing so well. They raised their dividend 6% not that long ago. They've got a great history of increasing dividends, which is, again, something we look for. It's recession-proof. If things go bad, everyone's going to go to the movies more. But their average revenue per client is less than $9. I don't know about you, but when I go to the movies with my kids, I spend about $200. So there's plenty of room to move that average revenue ticket up. And again, that stock just keeps going, just sort of goes up a little bit every day. It never, makes the paper for its big move, but over the past couple of years, it's more than doubled, and it's pretty solid as far as we are concerned.
Get more investing advice from our roster of experts, including Rick Rule, Mickey Folk, Eric Coffin, Brent Cook, Steve Palmer, Tom Calandra, and James West by visiting smallcappower.com/experts. smallcappower.com, investment ideas and research.